You have sat in a room where people were talking about stocks, the market, the S&P, their portfolio, their brokerage account, and said nothing because you did not understand a single word of it. Not what a share actually is, not why any of it would matter to someone who does not already have serious money to start with. The S&P 500 has returned an average of 10% per year since 1926. The average American savings account pays less than 0.5% in annual interest. Inflation runs 2 to 3% every year. Every dollar sitting in a savings account is losing purchasing power in real terms while the market compounds quietly in the background. That is not an intelligence problem. That is an explanation problem. This video fixes that. There is one reason the stock market has never permanently gone to zero. Despite the Great Depression, the crash of 2008, and a pandemic that dropped the market 34% in 33 days, it came back every single time and set a new all-time high. By the end of this video, you will understand exactly why. This video covers what a stock actually is, how prices move, what the S&P 500 is, how compounding works, and why the market has gone up for 100 years despite everything thrown at it. Here's what a stock is. A stock is a percentage of legal ownership in a real company, not a lottery ticket with a ticker symbol. Actual ownership. When you buy one share of a company, you become a part owner of that company. A small part, but a real and legally recognized one. This matters because everything that happens in the stock market flows from this one fact. If the company earns money, your ownership is entitled to a portion of that money. If the value of the company grows, the value of your slice grows with it. Picture this. Nike designs and sells shoes and athletic gear across nearly every market on earth. After paying every employee, every factory, every shipping cost, every operating expense, there is money left over. That remainder is called profit. Nike has approximately 1.5 billion shares outstanding. You purchase one share. You are now entitled to your proportional share of everything Nike earns from this point forward. For as long as you hold that share, you did not design a shoe, you do not manage a single employee, you just own the piece. Some companies take that profit and pay it directly to shareholders in cash every single quarter. That payment is called a dividend. Coca-Cola has increased its dividend payment every year for 61 consecutive years. Johnson & Johnson has paid uninterrupted dividends since 1944. Every quarter, cash flows into every shareholder's account. Not because they did anything new, because they own a piece. Other companies reinvest those earnings into the business to grow faster. Amazon did this for years before paying any dividend. When the business grows, the value of your ownership grows with it. The key point is this: a stock is legal ownership in a fraction of a real business producing real earnings in the real world. Every concept in the market is a consequence of that single fact. But knowing what a stock is does not explain why prices swing so dramatically. That requires understanding the pricing mechanism itself. Here's what determines a stock price. The price of a stock at any moment is the last price a willing buyer agreed to pay and a willing seller agreed to accept. A live auction, running every second the market is open, 5 days a week. This matters because most people assume prices reflect what a company is objectively worth. They do not in the short term. They reflect what the most motivated buyers and sellers agreed to in that exact moment. Picture this. A company releases quarterly earnings. They earn $2 per share. Analysts predicted $1.80. They beat expectations by 11%. Within minutes, every institutional investor sitting on the fence makes a buy decision. Every trader betting the stock would fall scrambles to exit the position. Demand spikes. The stock rises 8% in one afternoon. The company did not become a better business overnight. More people wanted it. Reverse it. Same company, next quarter, they earn $2 per share again. Identical performance. But analysts now expect $2.40. They miss projections. Sellers flood in before the close. The stock drops 12%. The business is identical to what it was yesterday. In the short term, prices track expectations more than reality. A company losing money can see its stock triple because investors believe in its future earnings. A consistently profitable company can get crushed in a week because it grew slower than expected. Over years, something different happens. The actual earnings of the underlying businesses accumulate. Prices eventually catch up to what those businesses genuinely produce. In the short term, prices deviate from earnings constantly. But over any decade on record, market performance has tracked closely with the cumulative earnings growth of the companies inside it. The key point is this: price is not a verdict on quality. Price is an auction. Short term, it reflects what the most impatient buyer and seller agreed to. Long term, it follows what the business actually earns. Knowing how prices move explains individual stocks, but it does not explain how anyone builds real wealth without predicting every company correctly. That is what the index solves. Here is what an index fund is. An index fund is a single investment that buys and holds a defined basket of stocks, tracking the performance of the whole group as one position. This matters because it eliminates the guessing problem entirely. Picture this. You put $1,000 into an S&P 500 index fund. You now own a fractional piece of the 500 largest publicly traded companies in the United States simultaneously. Apple, Microsoft, Amazon, Berkshire Hathaway, Walmart, Google, United Health, Exxon, all 500, one purchase. The S&P 500 is maintained by a committee that reviews and adjusts the list periodically. Companies are removed when they shrink below the size threshold or collapse. New companies that grow large enough get added. The index self-corrects. You do not manage it. It manages itself. One company in the basket has a catastrophic year. Your exposure to that single company is roughly 0.2% of your total investment. It barely registers. The other 499 carry the weight. 2023. Nvidia went up 240% because artificial intelligence demand exploded globally. Most investors had no idea that was coming. But every person holding an S&P index fund owned Nvidia. Every one of them captured those gains without predicting them because the index owned everything. That is the design. Stop trying to pick the winner. Own all of them. Some will underperform. A handful will be extraordinary. The average of all 500, compounded over every measured period on record, has been approximately 10% annually. Warren Buffett, arguably the most successful individual stock picker in history, has publicly stated that most investors, including most professional fund managers, would produce better results by holding a low-cost index fund for decades. He won a $1 million public bet, proving it against a group of hedge funds over 10 years. The key point is this: an index fund is how you own the American economy in one purchase without selecting a single company. The S&P 500 has averaged 10% for nearly 100 years. Now here is the answer to the open loop from the beginning of this video. Why has the stock market never permanently gone to zero? In 1929, the Dow dropped 89% from peak to trough and took 25 years to recover fully the Great Depression. 25% unemployment, bank failures nationwide. It recovered. In 2008, the financial system nearly froze completely. Major institutions required government bailouts to survive. The S&P fell 57%. It recovered. In March of 2020, a global pandemic shut down the global economy in 30 days. The market dropped 34% in 33 days. Fastest crash in recorded market history. 1 year later, it was at an all-time high. Every single time. Here is why. Here's what the long-term trend of the market actually represents. The accumulated earnings of every company inside it, compounded forward across time. This matters because companies do not stop earning money because stock prices fall. March of 2009, markets are at 12-year lows. Every headline is catastrophic, but Amazon is still shipping packages. McDonald's is still selling food. Johnson & Johnson is still filling prescriptions. Apple has just released the iPhone 3G into a market that has no idea what is about to happen to that product category. The fear is real, the selling is real. But every business kept operating, kept earning revenue, kept making things people needed, and bought every single day. Stock prices fell because sellers outnumbered buyers, not because the businesses disappeared. And then the companies kept earning. The earnings accumulated. The prices caught back up to what was actually being produced. 1 year after the March 2009 low, the S&P was up 68%. 2 years out, it had doubled. The companies did not change. The sentiment ran out of room to fall. The key point is this: the market cannot permanently go to zero as long as the companies inside it keep earning money. As long as people keep buying food and medicine and technology and fuel, those companies earn. Ownership in those companies compounds with their earnings. That is the entire mechanism behind 100 years of upward trend. Here's what compounding is. Compounding is what happens when the returns generated by your ownership generate their own returns the following year and the year after that continuously. This matters because time is the only variable in this equation that cannot be bought back once it is gone. Picture this: you are 25 years old. You invest $10,000 in an index fund and do not touch it. At 10% per year, that $10,000 becomes $25,000 by age 35. Not because you added a single dollar, because the ownership compounds on itself. By age 44, it is $67,000. By 54, $174,000. By 65, $450,000 from one $10,000 investment. Now start at 35 instead. Same $10,000. Same 10% rate. By 65, that investment is worth $174,000. Same investment, same rate. One person ends up with $450,000. The other ends up with $174,000. The only difference is 10 years of starting earlier. There's a shortcut called the rule of 72. Divide 72 by your annual return rate, and you get the number of years it takes to double your money at 10%. That is every 7.2 years. Your 10,000 becomes 20,000, then 40,000, then 80,000, then 160,000, then 320,000. Each doubling cycle sits on top of all the previous ones. The further into the future you project it, the more extreme the difference between starting now now and starting later becomes. Most of the $450,000 earned by the person who started at 25 is generated in the final decade of that chain. Not the first 20 years, the last 10, because by then the base is so large that 10% of it is a massive absolute number. The key point is this: the market does not reward intelligence, it rewards time. Every year you delay is not a flat year. It is a doubling cycle removed from the chain that cannot be recovered. So if the market returns 10% per year on average, index funds are accessible to anyone with a phone. And the math of compounding is this straightforward. Why do most investors fail to capture that return? Here is the actual number. Research tracking real investor behavior over a 20-year period found that the average stock fund investor earned 3.7% annually during a stretch when the S&P 500 returned 9.9% per year. They were invested in the right instrument. They got less than half the return. The financial research firm Dalbar has measured this behavioral gap every year since 1984. The finding is consistent across every decade and every type of market. The average investor underperforms the market they are invested in. The cause is timing decisions made when prices move, not fees, not fund selection. This matters because the gap is almost entirely self-inflicted. Picture this. Two people each invest $10,000 in the same index fund in January of 2008. Person one watches the account closely. By March of 2009, the balance shows $5,800, 42% gone in 14 months. Every headline is catastrophic. The consensus says it could go lower still. They sell. They lock in the loss. In 2011, when the recovery is confirmed and headlines have turned positive, they reinvest. They capture the entire crash and miss the entire recovery. Person two sets automatic contributions and never opens the app. They have no idea what the balance shows during the crash. In 2012, their account has recovered fully. In 2015, it is worth $22,000. By 2024, it is approaching $55,000. Same fund, same starting amount. One person is still trying to recover their losses. The other has more than 5 times their original investment. The market made no distinction between them. It treated both identically. Person one interrupted the compounding. Person two did not. That is the entire explanation for the gap. The key point is this: the market rewards patience and punishes reaction. Monitoring your account every day is not diligence. It is exposure to the emotional trigger that causes most investors to destroy their own returns. Here's what you now know. A stock is legal ownership in a fraction of a real company. When that business earns money, your ownership earns money. Companies go public to raise capital to grow. The stock market is where that ownership gets exchanged between investors every single day. Price is an auction. Short term, it reflects what the most motivated buyers and sellers agreed to. Long term, it follows the earnings of the actual business underneath the symbol. An index fund owns the entire economy in one purchase. The S&P 500 has averaged 10% annually for nearly 100 years. You do not have to select a single stock to access that return. The market has never permanently gone to zero because the companies inside it never stopped earning money. Crashes are temporary disruptions to price. The earnings of real businesses are continuous. Prices always catch back up. Compounding doubles your money roughly every 7 years at 10%. The person who starts at 25 ends up with 2.6 times the retirement balance of the person who starts at 35 with the same investment, same money, same rate, just time. The reason most investors underperform the market they are invested in is behavior. They sell at the bottom when they are afraid and buy back at the top when they feel confident. That cycle captures the loss and misses the recovery every time. Open a brokerage account this week. Put money into an index fund. Set automatic monthly contributions, even if it is $50. Do not look at the balance for a year. Set it and let the chain run. The only mistake in this game that cannot be fixed is never starting at all.